Okay, guys, let's get straight to it. First of all, I'm not a financial advisor, neither that this is financial advice. AB Investments is with you. Please, guys, subscribe to this channel if you haven't yet, and like the video. Let's get this video out there because this is really important. Couple of videos, very important. So, an uncovered call, basically, it's the like probably the simplest thing you see because that's what most people are YOLOing on. The uncovered call, if you know it, just please bear with me for a little bit. If you don't, you get to know now, is when you're buying a strike price. Basically, you're predicting at that point that that underlying asset, which is, let's say, AMC in this case, we'll use that as an example, and you say by such and such day on that option chain that you're trying to buy, that AMC, for example, let's say February 2020, 22nd, which is a week from now, like in the 28th, I think, or the 18th this week. When you go to buy it, it will give you all these strike prices. And when you're trying to choose through these strike prices, you're basically predicting that the price is going to be over that price before your time is up, before the 18th, basically, before the expiration date. And if it doesn't, you lose all that money that you paid for that contract. So let's say it was costing you $15 to buy that contract. Then if that price by that day does not go above it, not just even to it, above it, there's a break-even price that it will say there. For example, it will say, let's say you bought the $20 strike price. It will say like, okay, your break-even is 20 and 83 cents. If, let's say by the 18th, it breaks at, let's say it breaks just $20 and 30 cents, then your call, your uncovered call, is basically worthless now. Your premium is gone. The only thing you would have at that moment is they will give you another option called exercising. What that means is you are vowing, since it broke over that 20 that you were predicting, you already lost. The premium is gone. The market maker takes that. What you're basically saying is, if you want to exercise that call option, is you want to purchase, because the call options, the way that they work is that each call option is equivalent to 100 AMC stocks in each one. So it's a coupon. You're not buying the stock, but hypothetically speaking, if it goes over the $20 that you predicted that it will go over, that you would have the option to go ahead and exercise that option and pay $20, basically multiplied by 100, which is $2,000. So $2,000 you basically are gonna pay. You have to have that money also on that account, so that you can exercise that option. So simple math here, easy. That's what an uncovered call is. If you don't meet, again, the 20, you lose that premium. That's all you lose, is the $15 that you initially paid for that contract. If you bought more, you get the point. And again, each one, because a lot of people get confused with the exercising part, each one that you're gonna buy is equivalent to 100 stocks. So even if your price gets to the strike price, but it doesn't go over the break even, that means you're not in a profit, then the premium is gone on that option. But you would have to buy, if you want to exercise, you'd have to buy any of these, obviously, strikes, any of these options that you purchased if you want to exercise. So again, it's not just going to be $20 and you get an AMC stock. No. Again, at whatever it is, you have to multiply it by 100. That's what you're vowing for. So what a lot of crazy people were doing was they were getting calls, uncovered calls, way out of the money, like way over where the price of the current stock is. And I'm not saying that's, I don't say yes or no or good or bad. I just think it's very ludicrous. If you don't know much about options, that means your knowledge into the market itself is still not that fluid. And it's nothing like, bad. It's just a matter of time before you get to know all these little things, in and out. So That's the same thing that I explained about the uncovered call. It's the same exact method for the uncovered put. The difference is the put means you predict that the price is going to go under, versus that the call you're predicting that it's going to go up. I wish I know how to do screen share, where I can share like with my computer. Like many of these other YouTubers. Don't worry, guys. I owe it to you to know and learn. But if any of you, of my beloved community members know or can't explain how, like I'm explaining about the calls, please help me learn how to do screen share so that I can actually show better. While I speak in the background, I can show better an example what each and each one means. But yeah, so like the puts and the calls, that's what it is. Calls means you're predicting it to go up. Puts means you're predicting it to go down. Whatever strike price you buy, if it doesn't meet it by the expiration date, all the premium is lost. You lose all that money. If you reach that price but you don't reach your break-even price, then by the expiration date, then you would have you lose the premium anyway, but you still have the ability or the option to exercise and buy that, like that coupon, like submit that coupon and basically get your right to buy those stocks, to buy them as shares. So that option would dissolve and it will become just 100 stocks if you're just buying one. And you basically can buy them for whatever the strike price that you selected. So if you selected 40, you would have to buy each one for 40. If you selected the 10, you'd have to buy each one for 10. Remember, the closer the strike price to be in the money, or this, whenever the strike price is in the money, when they say in the money, that means it's already in that price range. So like right now, AMC is at 19. If you're buying the 19 or the 18 or the $17 strike prices, then that means it's in the money already. Those will be a lot more expensive. See, that's where the risk goes. The less risky, the more you pay. The more risky, the less you pay. People basically were doing the less to pay, but a lot more risky. And if they didn't know much about, how to play it, especially when you don't know much and you're playing week out or 2 weeks out, that's the ultimate recipe for disaster. I kid you not. Like, this happened to me in 2018, and again, I've seen it happen so many times to so many people, and that was their nail in the coffin to break them down. Now, what the market maker was doing throughout 2021 until now was a bunch of other options. There's other plays. It's not just uncovered calls and uncovered puts. Call that the basic like options 101. Like, that's how you get into options. What they were doing was a combination of long straddles and long strangles. And what the long straddle is, it's a little bit more confusing, is basically the same thing, but a lot safer. So you get to basically, with the long straddle, you will purchase two options. One as a call, a long call, and one as a long put. Both will be purchased, and both will be bought at the same strike price too. This is really important. So you pay a little bit more, but what you're doing theoretically is you are predicting that there is a big move happening or coming. And again, you got to know the expiration date is very crucial. It's actually the most crucial thing. If no big move happens within the expiration date, then all options again are worthless. Doesn't matter which style you do, unless you have like a covered call, which is the safest, like literally the safest one, but it's just limited profit. I'll get into that in another video, maybe after this one. But I'm explaining the two that are more, I personally think that are the most important two. So the long straddle, remember that straddle, is when you're buying two options, one long put and one long call at the same time at the same strike price. So you're predicting that there's a big move happening, but you just don't know if it's to the up or to the down. Now, it does not matter to you if that big move really does come to fruition. Then you're gonna be like, you're gonna make crazy money. based on how far it goes and how much, it how much it makes for you when you sell it, your option. Um, Now, important thing about the options. See, I'm literally like freaking out because I might be speaking to some of the community members that like that is all this is new to them, and I don't want to I want to stress the fact that this is the riskiest thing in the whole stock market. The best thing is always to play the stocks and everything, and I'm not influencing anybody. Again, I'm just speaking my mind on my own channel. So I'm not a financial advisor, but the long, like I said, the long straddle is you buying two at the same strike price. Whether it goes up, you're going to be good. Whether it goes down, you're going to be good. But that big move has to happen if you're predicting it. So that's the best with these kind of meme stocks, because they are going to either pop really crazy or drop really crazy, just theoretically speaking. Now, there's the other one, which is called the long strangle. The long strangle is almost very similar to the straddle from as far as the theory of you buying two options, again, one that is a long put and one that is a long call. But the difference here is that they both don't have to be at the same strike price. They both can be at different, whether very far out of the money or very far into the money. It's up to you at that point. And again, same idea. If it goes really high on the up direction, obviously, then you're making money. If it goes really bad down, it drops bad, then you're making a lot of money as well. Most of the times, these two, the reason why I think that they're the most important two is because it helps with, especially like when there's earning calls. Okay, so like if let's say Facebook, when they did their earning call and they missed, or Amazon when they missed, you didn't, like, no one knew, like, before the call happened, the quarterly earning call happened, no one knew, like, in what, like, okay, it could be good, it could be bad, but they knew that it could be, moving in either direction. So if you implement any of these two, you're safe and you're good. But if you just go uncover call on, for example, Facebook, expecting them to have a good earning call, which majority of the people that I know, I swear to you, that I've witnessed and seen, that's what they just do. They just expect it to be a really good call or a really bad call, and they would just go put an uncovered call, just like that, or an uncovered put, and hope. It's kind of like getting lucky and trying to get rich by gambling at that point, because you're just getting lucky because you didn't really protect yourself in a way. It wasn't like an investment thinking, and if they missed their quarterly earnings and the price dropped and you bought an uncovered call, you just lost, and especially if you FOMO'd in and you went and bought like 100, 200 of them, and whatever it costed you, like $25,000 to $30,000 to buy those, you just lost all that money, especially if it's just a week out or 2 weeks out. Like, again, there's so many strategies to this, guys, and so many elements to this. If you have any questions, please comment in the comment section. I will be more than happy to answer any of the questions, break it down a little more. Just be careful, guys, because again, I mean, this really gets under my skin, guys. It's the guy literally said, I don't know much about options, and the very next day he's talking about, I'm putting in options on Sundial and I'm putting in options on AMC 2 weeks out, and it's like, I hope that it does, like, squeeze in the next week or so, as we're all kind of anticipating. But if it doesn't, imagine how many people got influenced by that in his own community, and possibly are doing the same thing and gonna get screwed over. This is sad. So much love, guys. Again, like and subscribe to the channel, share with everyone, and much love. See you in the comment section.